Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Jim Welsh of Macro Tides. Jim, great to see you. It's Friday. I always know it's Friday, and it's a great day because it is Friday, and we get to speak and get caught up about the markets. And guess what? You're right about the 4,300 level. It seems like you're almost right. It seems like we might make it up there.
Yeah. Well, the expectation has been, that the economy is okay for now. And that was really important to Wall Street in terms of, no recession, earnings going up. And today's employment number obviously reinforced that because it was, again, a pretty healthy number, better than expectations. And that, I think, is the foundation for Wall Street's bullishness, that the economy is going to avoid a recession, earnings are going to go up. And now, a belief after one of the Fed governors, Jefferson, talked about a skip at the June meeting. So Wall Street's convinced that irrespective of the employment report, the Fed won't hike in June. So it's kind of like the best of all worlds. And, my expectation was that once you got above 4,200 on a closing basis, technicians would say, wow, okay, that's a breakout. And of course, the fundamentalists will look at this strength, of course, and the data and say, there's no recession coming. It's the perfect setup, at least from my perspective, where you get everybody kind of turning bullish, a confluence of things come together just in time, I think, for the economy to slow materially in the second half of this year.
So it's interesting you say that, and this is just so everybody knows, this is what you've been talking about and laying out literally for the last couple months, that we would eventually break higher. It's going to suck all the longs in. Everybody's got FOMO right now. I mean, I know everybody's looking at 4,200 thinking, holy cow, things might be a little tough next year, but price isn't going to lie. We're above 4,200. Got to chase the markets higher, and so this, you think, is, in the words of Admiral Akbar from Star Wars, it's a trap. It's a trap.
Well, I think it could be, yeah. For faithful listeners of our broadcast, I just finished the June Macro Tides. If you send me an email, jimwelshmacro@gmail, I'll send you the June Macro Tides, which kind of lays out a lot of what we're touching on, but provides a lot more detail, a lot of charts and so forth. So jimwelshmacro@gmail, I'll send you the June Macro Tides. So, markets do that. The key is, are we going to have a significant slowdown in the second half of this year that starts to dent the expectation that earnings are going to be up 11% between now and year end? So if we don't see a significant slowdown, I'm going to be wrong. But as we've talked for quite a while, the things like the inverted yield curve, leading economic indexes, the big increase in lending standards that actually started late last year, all of them have lead times of 10 to 19 months. So it just means that it's a delayed reaction where the economy finally starts to feel the brunt and weight of all that monetary action. And I think that's what's going to show up in the second half of this year. And, excess savings, which, again, we've talked about, I've shown the chart of it off and on, has been a buffer against higher interest rates, as well as low unemployment and a lot of other things that have boosted incomes. But again, the three indicators I mentioned, going back to the last 50, 60 years, whenever they've reached the levels that they've reached, there's always been a recession. So, my take is, okay, even if we don't have a decent dip for a recession, it's hard to believe there isn't going to be a fairly significant slowdown. And when that starts to materialize, people start to think, wait a second, maybe we won't avoid not having a recession. That's just the way the game works. Yeah. So technically, the 618 retracement on the S&P is about 43.11 of the whole decline from the January high to the October low of last year. We're coming up to an important technical intersection. And again, I think the fundamentals suggests to me that the bullishness is just unwarranted.
Yeah, and I know you got charts, and you brought a chart pack with you today. So I'm gonna get right into it, and we'll talk about the S&P. And there's a ton of resistance up there, and I'm sure you're going to bring that up here in a moment. So let's start with your Fed funds futures. What are you seeing here, Jim, and why did you bring this up?
Yeah, well, since early March, Wall Street was looking for the Fed to start cutting rates in July. Because the regional bank problem. There's no way the Fed's going to cut rates this year with the unemployment rate near a 50-year low. So finally, the combination of Fed speak over the last couple of weeks and the economic data coming in pretty stronger than expected, all of a sudden, Wall Street is now, and this chart is hard because it goes all the way out to January of 2025. So you kind of have to look under the number 1 at the top, because that's about where year-end 23 comes in. And what you can see is, okay, there may be one more hike, whether it's June or July, and then there's no cuts until you really get into next year. So my only point is, this is something that we've talked about consistently over the last couple months, that the idea that the Fed would be cutting, especially as soon as July, was just, out to lunch. And so to the extent that markets were priced with that expectation, and I think the dollar was one of those markets, I just thought it was wrong. And now the Fed funds futures have kind of come around to, okay, they may increase it one more time, but the prospects of a cut, are pretty much gone.
Okay, and at least for this year, right? Well, the next chart you brought is PCE versus projections. Let's pull up that chart really quick. Yeah. And what are you seeing here?
Okay, so basically, every quarter, so March, June, September, December, when the FOMC meets, they provide projections. Each individual writes down, where do I think PC inflation is going to be? And so the blue band covers those who, at the high end, and then the lower part is the the more optimistic, and then you can see the dark line is the actual data. So what we can see is over the last few months, the expectations were for the PC inflation to come down more than it really has. And I think that's going to change. I discussed in the June macro tides, shelter and the way it's calculated, both in the PCE as well as in the CPI, lagged the real data that has been happening. So I think we're going to see core PCE inflation and core CPI start to come down more. But my point is that relative to what their expectations were, inflation isn't coming down as fast. And again, when some of the doves have been talking about, inflation isn't falling as fast as I thought. So, this lays the groundwork kind of for the next chart, because at the June meeting, June 14th, they're going to provide another set of these numbers. And, what I pointed out in the June letter is if you look at the PCE inflation, which is kind of in the middle, in December, they pegged it at 3.1 at the end of 2023. In March, they ticked it up to 3.3. So if I'm on the Fed and I'm willing to not raise rates in June, I don't want the markets to think that, I'm done raising rates. One of the ways the Fed can, if you will, strengthen their forward guidance that this is only a skip and not we're done, would be to increase the projection for PCE inflation for both the core and by a little bit. They don't have to do it by a lot. And then the last line is the Fed funds rate. As you know, in December and January, I kept saying, I think they're going to 5.1. The March PCE came out at 5.1. I'm like, hey, they're going to keep going. And they did. So if they want to push back on people's thinking that, oh my gosh, if the Fed doesn't raise in June, they're going to be done. The way to communicate that would be tick the inflation numbers higher and tick the Fed funds projection, whether it goes to 5.2, 5.3. But I would be surprised if that doesn't happen, Blake, because that's the risk. If they skip June, they don't want markets, I think, to get too frothy in anticipating that. And again, as markets rally, it does unloosen financial conditions, which is supportive of the economy. So I think
which isn't necessarily what the Fed wants right now, right?
It isn't.
Yeah.
So I just think that if they hit the button where they don't raise at the June meeting, the debate will be long and extended in terms of, well, how do we finesse this? How do we communicate that, we're ready to go again in July? And it looks that way, but we're just going to hold off because we've come so far so fast type of thing.
We communicate it by saying words like skip, I guess.
Yeah, they do it by skip, but it's more, I think, demonstrative to do it by, PC inflation isn't coming down the way we expected. So I'm going to say it's 3.4 at the end of the year. Oh, the Fed funds rate, maybe it's either 5.2, 5.3. And it just shows that within the committee that the center of gravity is shifting and being willing and open to the idea of increasing the funds rate at least one more time. And I just think that's, the other thing is, hey, you raise the funds rate at the June meeting and you kind of do somewhat the same thing. It's like, hey, inflation isn't coming down the way we thought. We may have to go a little bit further. I just think that they're at that point where it's a tough call, and they don't want markets to get ahead of where they think they should be.
Right. Well, speaking of which, let's talk about how all of this is going to influence the markets, Jim. First chart you brought is the dollar. So the dollar, it's pulling back a little bit. We have rallied. It looks like you're labeling this a possible C. So do you think we're finished here?
No.
Okay.
Again, my take, 4 or 5 weeks ago was that the Fed wasn't cutting rates and that the markets would finally understand that and that would be a tailwind for the dollar. Chart-wise, to me, it looks like from the lows back in January, you had an A up, B down, and a wave C rally that should carry. Sorry, I don't have that. 105.88 was the high that we saw in early March. So I think the odds are that the dollar is going to continue to push higher and at least test that 105.88 level and potentially break through. But I think the trend is still up. Last week, I noted that the RSI was overbought, the bottom panel there. And so a pullback was likely. And, we got it. And then today it's rebounding again because of the data, the employment data. Right. So I just think the outlook that most people had about the Fed that the Fed would cut rates in the second half of this year is one of the reasons why the dollar weakened from that label A down to the B. And if that was wrong, then it would rally back, and it has.
That makes sense. Okay, so the next chart you brought is gold. And I know you've been continuously telling us that gold could trade back down towards 1880 or something like that. Has your view changed here at all?
No. If you look at from the high at 2059, look at the daily chart. It looks like 1, 2, 3, 4, 5. Now, there's another way to count it that would be a wave C and all that crazy stuff. But just looking at it straightforward, it's like, okay, 5 down. That implies that that was wave A of wave 2. We're getting a bounce, and I thought we could bounce towards the 2000 plus or minus a little bit. And then I think there's another leg down that takes gold down towards anywhere between 1880 and 1920. The gold rallied for 30 weeks. It'd be reasonable for it to pull back a couple, 8 weeks, 10 weeks, something like that. So to me, this ties with the idea of some additional strength, the Fed debating, pushing back on the idea of, rate cuts certainly, and raising the prospects of a potential rate hike. So again, but the bigger picture is the rally from last September to May is wave 1 of a rally that will take gold to new all-time highs. All we're looking at is, okay, what's another entry that will be positioned well for the next rally up? Because I think the next rally is going to take gold above 2070, 2250, 2350 longer term. Those are some of the price targets I think are reasonable.
Very good. All right. Well, the next chart, Jim, and let me delete this really quick, this line. The next chart you have is the bond market, or TLT.
Yep.
You're still looking for a move higher in TLT.
Yep. Yep, I am. Again, it's just predicated on ultimately second half of this year, we're going to see the economy slow down. Inflation is going to come down. Shelter inflation is going to start to play catch up to the real world data we've seen over the last 9 months. And all of that, I think, is supportive of bond prices. Near term, I think there's the potential that TLT will drop below the 100.03, that this sideways correction is almost done, but there may be one more dip that can take it down near the hot lows of that 98.66 or whatever it is. So to me, it's just a question of looking again for an entry point before I think a rally that's going to carry in the second half of this year up to 115, 117. And again, from a chart pattern standpoint, from the low back in October to the high we saw in January, that's wave A. The sideways is a B wave, and then I think there's a C wave. And if they're equal, you get up towards the 116 area.
All right.
And I think that's coming.
Okay. All right. So that's what you think is coming now. I want to take your last chart. Here's the S&P. You've been looking for a move above 4,200 towards 4,300. We're finally there. I mean, literally, as we're speaking, we are hitting highs and we're getting close to that 4,300 level.
Yep.
What do you think from here?
I think that, again, my expectation is the economy is going to slow enough that earnings have to come down. And I think there's the risk of a recession by late this year, early next year is very, very high. And once that data really starts to point in that direction, I think the S&P is going to be vulnerable. As you noted, for weeks and weeks, it's like, I still think there's one more move up. We're finally getting it. And as I've noted, the 618 retracement of the decline from January of last year to October, 43.11. The August high last year was 43.25. So that's kind of what I've been saying. Hey, I think we got a chance for a pop. And I thought the debt ceiling would be done. Talk about the Fed hitting the pause button would be supportive. And I think that's what we're seeing. So to me, this is a place to sell into. We're starting to get a little bit overbought. I think the strength can carry into early next week. But again, my expectation is the Fed is going to be pushing back. And I think, 60, 90 days from now, things are going to look a little bit different. So I've advised people to say, okay, you get above 42.50, time to lighten up. And for those who are a little bit more aggressive, above 42.50, take a short position. And that's my expectation.
And just to note, you guys, because Jim, there's so many different levels that come in here. The range extension, the 4,300 levels, 127% extension of that range. So, there's a lot of targets up there, and it does feel to me, Jim, it does feel that we are in a situation where we are starting to see, people chase this market higher. The fear of missing out or the fear of underperforming. And you're getting this situation where everybody's trying to chase the market higher. So do you classify this as a regular musical chairs type of event?
Yeah, I think so. I mean, what we've seen this year, especially, is a small number of stocks, and a lot of people have been talking about this. Small number of stocks have been really carrying almost all the weight. And, is that a positive technical? No, it isn't. But it can go for a while. And we talked about this probably 4 or 5 weeks ago. That can continue for a period of time until you get a reason to sell. Whatever's in motion is going to kind of stay in motion. I think that reason to sell is going to show up as we get into the second half of this year, with the economy showing more signs of slowing. And what we're seeing today with the Russell is kind of like, oh, now that we're not really going to have a recession because the jobs report proved it, it's time to buy some of the cyclical stocks. So industrials are getting a pop. And again, to me, this is classic stuff, whether play out or not, we'll see, where everyone comes to a consensus that all that worrying about a recession was misplaced. This is the final proof. And the technicians can say, look at it, we got a breakout. It just, but again, it's all predicated on my belief that we're going to see much more slowing appear after mid-year. And if that happens, I think the market's going to be vulnerable.
Well, we are just about into mid-year right now, Jim, and so
right around the corner.
Yeah, I want to ask you again. Well, before I do this, if you guys and gals like what Jim's doing here, make sure you give him a thumbs up. Jump in the comments below. I know Jim's been having some conversations with some of you that have had questions about what he's been talking about and maybe your viewpoints. Throw them all down there in the comments. It does help this video. It does help the channel, and it helps Jim. So give him a thumbs up. Get in the comments down below. But Jim, what is that email address to get your most recent report?
Yeah, Jim Welsh Macro at Gmail, and I'll send you the June macro tides.
All right, Jim. Well, thank you so much for guiding us through this mayhem, and it looks like the 4,300 level. Your wish may come true.
Well, more importantly, I hope it's what comes next. That to me will be more important. So one step at a time, though.
One step at a time. All right, Jim. Have a great week and a great weekend. We will catch you next week.
You got it, Blake. Thank you very much.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.